What's going on, guys? This is Lior and welcome back to my channel. Now, what I thought I would do in this video is talk about a component of deal analysis that a lot of people overlook, whether they're looking to do a flip or a BRRR project, and that is holding costs, right? Holding costs are an integral part for you to analyze as a real estate investor, because as you do your numbers, and you look at your project costs, like construction costs, and you look at ARV, a lot of people forget about that middle component and don't analyze all the parts that go into it, right? So successfully analyzing your holding costs is going to be absolutely crucial to making sure your financial analysis of your projects is correct. So I'm going to dive into the different components of holding costs. So if that's what you're looking for, stay tuned. What's going on, guys? My name is Lior and welcome back to my channel. Now, before I get into the meat and potatoes, two super quick things, guys. Number one, if this is your first time on my channel, first of all, welcome. Second of all, make sure you smash that subscribe button for me. I'm putting out tons of new videos every single week, talking all about different facets of rental property and real estate investing, right? So everything from giving you my project tours to giving you tips and strategies and everything in between. So if that's the kind of content you're looking for, make sure you subscribe. So let's get right into it and talk about holding costs, right? And as I mentioned at the very beginning, right, the reason why I thought I would do this video is when I see a lot of newer investors' financial analysis of deals, they forget about this critical component, right? The execution of a project is not just, hey, I'm buying it for this price, I'm putting this much of construction into it, and it's gonna be worth that, right? You have to account for holding costs. And there's a couple of different categories of holding costs I'm gonna get into. So let's get right into it. Starting with number one, and probably the biggest one, is financing costs, right? Now, unless you're straight up buying properties in cash, and that could be you live in a super cheap market, or you just have a boatload of cash, right? Then this is probably not going to be as relevant for you. But for the majority of us that are financing our deals with banks or hard money loans or whatever, we have to account for the financing costs, right? Because whether we're doing a flip or we're doing a rental BRRRR project or something like that, right? When we're doing that construction period, we are going to be paying our mortgage every single month, right? So if it takes us 6-8 months to actually do the construction and either sell the property or do the construction and then lease out the property, right? You need to account for that and figure out exactly how much money you're gonna spend on your mortgage payments. Now, depending on how you structure the loan, this could be different, right? Some lenders will allow you to do interest-only payments where you're only paying interest on the total balance of your loan. Other lenders, if you're maybe going more residential, traditional financing, you're gonna have to do both. You're gonna have to do fully amortizing principal and interest payments. But either way, you have to account for these costs and calculate exactly what that's gonna cost you while you're renovating or doing your construction on the project. Now, the second type of financing cost, besides just the financing cost that you're getting from the bank, and again, this is dependent on how you structure your deals, is you may have some private money holding costs, right? And what I mean by that is if you've seen my videos on this channel, you know that a lot of my deals I structure with private investors, right? Usually for the 25% down payment plus other costs that I need for the project, I will essentially borrow from private investors. And sometimes in return for this money, I will give investors a % ownership in my project. Sometimes though, I don't give an ownership percentage, but I pay them a fixed rate of return, right? A fixed interest rate on their money. And if I am doing that latter, right, where I'm essentially borrowing private debt at a fixed interest rate, this is another financing cost that I need to account for in my numbers, right? Because again, let's say I'm doing construction for 6-8 months, right? And then I'm planning on selling the property, or I'm potentially planning on refinancing and doing like a cash out refi if you're doing a BRRRR project, right? There's still gonna be that period of time that you're gonna incur these private debt payments to your private investors. Just like the bank, right? Just like the bank is gonna have an interest rate on their money, so is your private lender. And chances are actually the private lender might even have more expensive rates, but that's besides the point, right? So the point is, if you're gonna borrow money privately, and if it's gonna be structured as debt where you're paying someone a fixed interest rate, again, that's something else that absolutely needs to be accounted for in your numbers when you're doing your financial analysis. Now, the second category of holding costs that I definitely urge you to analyze is taxes and utilities, right? Now, for taxes, That's pretty straightforward, right? Again, as soon as you close on a property, you're going to start incurring all costs that are due with a property, and taxes are obviously one of them. So even though, let's say you're doing a BRRRR project and you're going to rent out at the end, even though you're not collecting rent while you're doing your construction for, again, the first 6, 8, 9 months, whatever it is, right, you're still going to incur a tax bill over that period, right? The city's obviously still going to charge you, and you're going to have to make those payments. And to calculate that, that's pretty easy, right? You can just look up whatever the current tax bill is for the property, right? You can look that up on assessor's database. That's pretty straightforward. And again, you can figure out based off those numbers what your monthly or quarterly, depending how your city bills you, what your monthly or quarterly obligations are going to be for the taxes. Now, the second part of that was utilities. Now, utilities is probably going to be a probably less significant component of your holding costs. I mean, they certainly exist. It's probably not going to be a ton compared to your financing costs and your holding costs, but it's good to include there as well, right? And with utilities, even though you don't have tenants living in there, and it's not like you're going to be using electricity or gas or water all the time, chances are during the renovation process, you are going to be using the utilities, right? You're probably going to have water usage at some point. You're probably going to have lights on site. You might need to use some gas, maybe for heating if you're doing a project in the north in the winter, right? So the chances are you're probably going to use some sort of utility. So you should certainly have a utility allowance or a monthly utility allowance for your project while it's under construction, right? You don't want to just be left holding the bag on that. So definitely account for monthly utilities as well. And finally, the last component that I think you need to think about, and this could be potentially qualified as a soft cost rather than a holding cost, depends how you look at it. But that last category of holding costs is going to be insurance, right? So there's two buckets for insurance. First, there's going to be your typical property insurance, right? So that's just going to be the insurance policy for the property, and that's like any standard homeowner's insurance. But if you're going to be doing some serious construction, it becomes a little bit more complex. You're going to have to talk to your insurance agent about getting a builder's risk policy, right? Basically, because you're going to be doing heavy construction, and there's obviously chances of liability, et cetera, or things going wrong on site when there's tools and all that involved, you're going to have to probably get what's called a builder's risk policy. Now, those are certainly much more expensive than your typical homeowner's insurance. But again, this is another cost that you're going to incur as you are renovating and doing, and undergoing the execution of the project, right? So make sure to account for that as well. So those are the three key kind of buckets of holding costs that I strongly suggest for you to analyze upfront in your numbers before getting into any project. This is kind of distinct from soft costs, right? Notice that holding costs and soft costs, I kind of differentiate a little bit. Soft costs, I'll do another video on, but those are going to be costs that you might not necessarily, that might be associated with a project that are maybe like attorney fees, general contractor fees, staging costs. If you need to do any sort of like city utility plans or city water sewer plans, stuff like that, right? Those I kind of consider more soft costs than necessarily holding costs. Holding costs is something I associate directly with the duration of how long you hold the property for, right? So make sure you account for that in your numbers. Again, these are certainly going to impact the financial outcome of your project and of your property. And if you don't analyze them up front, you will get bit on the back end. I promise you that. So hopefully that makes sense, guys. If you have any questions, make sure to put them in the comments below.